Hey everyone, Mark Panazon here, mortgage broker, Mortgage Connection. Welcome back. Today the Bank of Canada met for the first time in 2025 and they cut their overnight policy rate by 0.25% as widely suspected. So I'm here today to break down that rate cut, what it means, and some of the other numbers that are associated with that. So you can see here on the chart that this is the Bank of Canada overnight rate. So we've now been on 6 consecutive rate cuts since the Bank of Canada paused at the peak here somewhere around May of last year. So the cutting cycle has continued, and as I've mentioned in previous videos, I think we're nowhere close to being done yet. If you look at past cycles, these have been big moves down here, and I think we're kind of headed in a very similar trajectory here. So that's the big cut today. I want to show you Dr. Sherry Cooper's announcement here, where she is the leading economist for Dominion Lending Centers. She's our economist essentially, and we lead on this. So a couple important notes here. So obviously she's cut the rate, or the bank has cut the rate by that 25 basis points and bringing down the overnight rate to 3%. We just went over this, so that's the 3% rate. The bank also announced it's going to conclude the normalization of its balance sheet by ending quantitative tightening. Remember, quantitative easing is printing money and quantitative tightening is the opposite. So it looks like they're going to stop tightening. That was interesting. Then also the bank forecasts CPI inflation will remain around the current target for the next 2 years. So they believe that inflation is going to stick around the current levels. And if we bring inflation up here, which is the yellow line, you'll see that we obviously had that big peak post-COVID and it's come back down. And now we're at that 1.8% and the bank loves it at 2. So we're actually just slightly under the target. And that's kind of been the norm for the majority of the last, 50 years or so. And so now that inflation is under control, that's more incentive for the bank to keep cutting. And in previous cycles, typically the bank rate usually is under inflation. You'll kind of notice here that typically it's underneath inflation, except for in inflationary times like COVID, where inflation was higher than the bank rate, like in 2006, 7, 8, when we had the great financial crisis in the US, it was higher than inflation. And then 2000, leading up to 2000, the dot-com bubble, where inflation was creeping up above. You can see it peaked up here in about 2002. So it looks like the trend should be reversing. We should get this number below 2%. And if that is the case, we still have another 1% roughly of rate cuts to occur. But I'll continue on with the article here. She also mentions here that the bonds surged, so that's fixed rates, as the market absorbed the central bank's decision not to guide future rate moves. The yield on the Canada 2-year note slid some 4 basis points to 2.79, the lowest since 2022. That means the 2-year fixed rate is now becoming more attractive. More on that later. Tiff Macklem, the Bank of Canada Minister, mentioned that monetary policy has worked to restore price stability. A broad-based trade conflict would badly hurt economic activity, but that the higher cost of goods will put direct upward pressure on inflation. So what he's saying there is that if tariffs come into play, that's not good for economic activity. That's going to put more pressure on prices, and that may force the Bank of Canada to cut even more than getting to that sort of 2% target that I'm mentioning here. So Dr. Sherry Cooper believes that the Bank of Canada will continue cutting in 25 basis points increments until it reaches 2.5% this spring, triggering continued strength in the Canadian housing market. So it looks something like this. Today we cut to 3%, and she believes by, say, looks like April or June, that they're going to cut another 0.5%. Which I do think is a pretty modest prediction. Pre-COVID rate was 1.75. I think we're headed closer to 2% personally. But that's kind of what Dr. Sherry Cooper had to mention. And that was her comments based on Tiff Macklem's comments. Now, we've already showed you the overnight rate. We showed you inflation coming down. I want to just reference the monetary policy report again. So this is what the Bank of Canada put out. Their projected target was 2.75. Again, we're currently at 3, and they were projecting 3.5 by January. So we're 0.5% faster or deeper cuts than what they were originally projecting back in October. So we're ahead of schedule. We're cutting more, and they're anticipating 2.75. And if we're already 0.5% over, that's where I kind of think we're going to end up at maybe 2.25 or 2.25 by April, June, somewhere around there. So we'll see what happens. If we flip to the bond yields real quickly here, so just focusing on the fixed rate side, not just the variable rate side, we sort of just been chopping around here since October of last year. So, fixed rates follow the bond yield. So if we take a zoomed out picture here, we've clearly peaked September of 23. So we rid this thing all the way up post-COVID. And then we've been slowly edging. We crossed the 200-day moving average, which is that blue line. And we've hit it a couple times, and it's been rejected each time it's hit. So I think we're in for lower fixed rates in the future, but I do think they take longer. Obviously, when the Bank of Canada makes a rate announcement, variable rates slash immediately, whereas the bond yields take much longer to unfold. There's a lot of other factors that go into it, like the U.S., like world politics, geopolitics, unemployment, GDP, all these other things come into play. Sort of moves more like a stock. In the short term, I think it's going to continue to chop around. We have a Canadian election coming up probably in the next 2 months here. We'll see what happens there. Moving on to a comparison of fixed versus variable rates. I'm just going to bring those two up here. You'll see that variable rates have made this massive move down, and now we're really close to fixed rates. And now that you'll notice once I get into the interest rates next, that fixed and variable rates are almost in line with each other. So they're more or less the same rate, whereas, about almost a year ago, there was quite a huge spread, about 1.5% difference between the variable rates and the fixed rates. So now that's starting to normalize, and I suspect that this is going to then invert with the bond yields, and we'll get back to a normal pattern of variable rates, which is the black line, typically being lower than fixed rates typically being lower than variable rates, which is the blue line. So we'll see what happens there. Now, if we look at the interest rate environment, in terms of like the general scope, we have about 16 lenders loaded up here. The lowest rate now is about 4.39%. And that is with one of our lenders on a 3-year term. So, the 3-year is still wildly popular, has been the most popular term over the past 3 years. So if you consider that, we know that the 2-year is starting to get more attractive. It's still not there yet, but we're now down to 4.5%. And it's generally been in the 5s for the last year plus. So we're moving in the right direction on those shorter terms. But once we start looking at variable rates, you can see that some of the banks have already started cutting rates, and it's showing here. So Scotia is at 4.65, and all these 4.8s haven't adjusted their rates yet. So you'll notice that the new rates are going to be closer to 4.5%. So 4.5% for a 5-year variable rate mortgage. And when you compare that to a 5-year fixed rate mortgage, we're sitting around 4.39 and up, which is very similar to that 3-year. So we have, 3 pretty good options and all very much aligned. You have 4.3 for the 2 most popular fixed rate terms, and then now this one is going to be at 4.6. And I just want to see if they've actually adjusted that one yet. Where is it? There it is, 0.8. So it's prime minus 0.8. So today, prime rate got dropped to 5.2 minus 0.8. So it's actually going to be 4.4. They haven't adjusted theirs. Yeah, so going back to the three comparables, you get 4.39, 4.39, and now 4.4 once prime rate adjusts today. So that's where the rates are all basically lining up, and we're right at this sort of pivotal moment here where variable rates are about to cross over. Fixed rates will continue to eventually, reduce, but obviously the move is going to be much more dramatic, much more aggressive on the variable rate side, pushing a lot of clients that way right away. Now, if we compare the two options based on today's data, we know we can get 4.39, and then we will soon get 4.4. So there's going to be a very minor difference at the moment. You can see the payment difference on a $400,000 mortgage. On the fixed is $2,189 versus $2,191. So the $2 difference, there's really no difference. But if we do get those two additional rate cuts as we're expecting, I'm pricing them in here. You'll see that, obviously if the rate is currently the same and you get those two rate cuts, which is the purple line here, you're going to save about $9,000 over the course of 5 years with that variable rate mortgage. If there's more rate cuts to happen, which is my view, that number might double. You might be close to $20,000 in savings. Now, we don't know what's going to happen after that, but clearly we're in a good spot here to pick the variable rate and see how low it will go. So a couple other factors to consider here is unemployment. So unemployment rates continue to trend upward. The December number was 6.7, slightly down from November, but since early last year, they've just been doing nothing but going up. You can see really since about March of 23, they've continued to go up. So this is a negative number for interest rates. If unemployment is still going up, that means things are unaffordable, people aren't working, so rates need to come down to help people out. So this is a bullish case for rates to continue to come down. Next, if you look at the current rent inflation, actually, let's look at rent inflation. Rent inflation decreased, so you'll notice that since inflation has reduced now to that 1.8%, a lot of it is being felt with rents. So rent inflation was 8.9% in August of last year. We're down to 7.1%. So while inflation is still high on the rent side of things, we're moving in the right direction there. So that's interesting. And then on the housing starts, so how many homes are we building? We started trending upwards since the summer. We really hit this bottom in August, but then we've been kind of moving back up. 267,000 homes in Canada is still not going to crack the number. In December, we took a dip down to 230,000 homes. Remember, the number we need to keep up with demand is closer to 500,000. So we're not even close to that. We're not going to be close to that. We've never really hit that number. The closest we got was March 21 at 320,000. And remember all that ecstasy with low interest rates post-COVID. We're building 320,000 homes. So there's still going to be, in my view, a great problem with housing demand and supply. We're not going to build enough homes to keep up with the demand. Now, I don't have the population immigration numbers pulled up, but we do know that Canada put up a very aggressive slowing of immigration over the next 6 years. So that will help, but this number is still nowhere where it needs to be. Lastly, I just want to go over some of the housing stats here. So if we look at some of these numbers, some of these charts here. So residential sales activity. So this is for Canada. You can see that sales have been increasing over time. You can bet that that's because interest rates have been lowering. So more people coming off the sidelines. If you look at new listings, same kind of thing. More and more people selling their home, perhaps upgrading, perhaps because of the demand issue, prices increasing. The market balance is relatively balanced right now. You can see that the months of inventory is around 4 months. So that's a pretty healthy spot, probably leaning a little bit towards the seller's market. Average price is flattened out from the high here in 2022. So we've had this dramatic run up with low interest rates and then sort of a crash when rates were high. And then now it's just kind of leveling out again. Average price per province, here in Alberta, we're still looking at an increase of about 9, almost 10% year over year. And then the other province I cover is in BC, so they're at about 6%. So, prices are still going up. They kind of break it down here by different type of home. Yeah, that's about it. So, lots of interesting numbers here to go over. I think that ultimately, rates are going to be coming down, and interest rates are a lot more attractive now than they were for variable rates than they have been in the past few years. And so what we're recommending to everyone is definitely consider the variable rate if you can afford the risk. Consider the future rate cuts in advance. And then make your decision from there. And then remember, with your variable rate mortgage, you can always convert it out of a variable rate into a fixed rate anytime. So I think your best scenario, my best advice, for this month of January leading into 2025 would be to consider the variable rate for probably about 2 years and then convert out of that variable rate into a fixed in about, let's say, 2 years time, when fixed rates will probably eventually hit their low, and then convert, and hopefully you can lock in a fixed rate for a longer period of time at that point. That's it for today, guys. Thanks for watching. Have any questions, let me know. Have a great day.